Okay, so we have some information about this company. We have, if you can see, this looks like a cash flows problem like we did in chapters 8 and 9 with capital budgeting decisions. It is because the purpose of the weighted average cost of capital is using it for discounting capital budgeting decisions. So we're going to pull all of those chapters together in this example. So we have expected earnings before interest and taxes for the next year. Then we have some information about increases in depreciation, net working capital, capital spending, and our earnings. We're going to do some calculations. So we're going to start with um, our year one information. So we have our earnings before interest and taxes of 2,450,000. Okay. Then for the next year, we see that we're expected to grow 18% per year for the next few years. So we have the previous year plus or times 1 plus the increase. So our increase in EBIT. And we can lock that cell and then copy that over because in year 3, we want year 2 times 1 plus 18% and so forth. Next is our depreciation. So in year 1, we expect depreciation to be 180,000. We expect that to increase by 18% each year. So very similar thing, year 1 times 1 plus our increase. Lock your increase cell. Yep, depreciation. And instead I deleted the cell. So copy that over. Then we have our tax amount. So remember the tax amount is earnings before interest and taxes times our tax rate. We're going to lock our tax rate cell so we can copy that formula. So we have our taxes every year. Then we have capital spending. So capital spending in year 1 is going to be 185,000. And then that's going to increase by 18% every year. So 1 plus our increase in capital spending. We copy that formula over. And then last but not least, changes in net working capital. Year 1 is 85,000. We expect that to increase also by 18% every year. Change in net working capital. So if we're trying to calculate our cash flows from assets, that is EBIT plus depreciation minus taxes. So plus depreciation minus taxes minus capital spending and minus change in net working capital. So if you remember that formula from chapter 2, so see how we're reusing, we're doing chapter 2, chapter 8, chapter 9, chapter 12, all together. So year 6, cash flows from assets, we take our year 5 cash flows from assets times 1 plus, and for this one we use our terminal growth rate. So that there's only so much we can grow. The terminal value is our year 6 cash flows divided by our weighted average cost of capital minus the terminal growth rate. So our terminal value is $55,567,647.20. Our company value is the net present value of these years. So we're going to do the net present value. Our rate is weighted average cost of capital. And then we're going to pick each of these cash flows. And in year 5, we're going to add the terminal value of the company. So we're considering this extended growth out. So we have company value is 45,904,941. So now we want to figure out what our value of equity is. So we know that debt plus equity equals our value. So we need to take our value minus the value of equity, our value of debt. So subtract our value of debt, and that gives us our value of equity. We then take that value of equity divided by the shares outstanding, and that is the current price per share, or the price per share of the company's stock based on our value of equity. So we kind of did an opposite calculation to find our value of equity and our price per share, utilizing information we have about the cash flows from assets, its projected growth rate, and its current debt.